I'm Sebastian St. James. This is Warren Buffett, possibly the most famous investor of all time. My question is, if you were to invest right now, would you be better off sticking your money in Berkshire Hathaway, Warren Buffett's company, or putting it in the S&P 500 index fund? I am a fan of Warren Buffett, but today we're going to objectively look at his track record, and I'll show you some original research. According to Yahoo Finance, Warren Buffett has had years of underperformance and a lot of bad stock picks. Oh, excuse me while I write this down. So Buffett's cons, according to the article, is years of underperformance and bad stock picks. Although probably not too many. The news came after a year of Buffett's acknowledging that he missed Amazon was a mistake. Yeah, I've been a fan and I've been an idiot for not buying, Buffett told CNBC's Becky Quick. He further noted that the decision to buy was not made by him, but by one of his managers, Todd or Ted. So I actually watched this interview. It is available on YouTube, and basically, yeah, that's exactly what he says. He acknowledges that he missed the train on Amazon. Todd and Ted, he never differentiates between them. It's always, Todd or Ted. He never actually says which one. Amazon was outside of my circle of competence. Buffett says he's made bigger mistakes than missing out on investing in Amazon. So there you go. So we'll add to Buffett's con list, missed Amazon. The thing about Warren Buffett and what triggered me to do this video is that he's had amazing track record. We know this particularly in his early years. He outperformed the market like many times over. More recently though, there has been some concerns that he isn't outperforming the market, so let's establish what we know for sure. Buffett's track record starts with 31.6% annual return during his partnership days from 1957 to an almost perfectly timed closure in 1968. So Buffett's pros, we can say he returned 31.6 between 57 and 68. Note the dates. Did this amazing performance happen during the time of Berkshire Hathaway, or was it before? Let's take a look. Warren Buffett purchased Berkshire Hathaway in 1965. So, between 1957 and 1968, basically it was the partnership prior to Berkshire Hathaway for most of those years. Berkshire Hathaway, now we think of that nowadays as an insurance company and as an investment vehicle. That's basically what it is these days. But what was it originally? Well, it was a textile company. Was it a textile company when Warren Buffett originally bought it? Berkshire Hathaway traces its roots to textile manufacturing company established by Oliver Chance. Here is a picture of the actual Berkshire Hathaway. This is it. Definitely textiles. I can see reels of cottons, or probably bobbins if you want to give them their correct name, and they look impressive. Here is an article dated the 7th of May 1958, so that's prior to Warren Buffett buying into it. Berkshire Hathaway announces mill closing. Oh, well that's not good, but it does speak to the decline of Berkshire Hathaway, which is probably why Warren Buffett bought into it in the first place. But on the day that Warren took over, was Berkshire Hathaway still producing yarns? Well, I've got a yarn to tell you. In 1962, Warren Buffett started buying stocks in Berkshire Hathaway after noticing a pattern in the price direction of its stock whenever the company closed a mill. So when he started buying up the company, they were definitely still in textiles. Eventually, Buffett acknowledged that the textile business was waning and the company's financial situation was not going to improve. In 1964, Stanton made an oral tender offer to buy back Buffett's stake in the company for $11.50 per share. Buffett agreed to the deal. A few weeks later, Warren Buffett received the tender offer in writing. Originally it was oral, but the tender offer was only for 11 3/8 rather than 11 4/8 or a half. Buffett later admitted that this lower undercutting offer made him angry. I'm not surprised. So what did Warren do? Instead of selling at the slightly lower price, Warren decided to buy more of the stocks to take control of the company and fire Stanton, which he did. However, this made Buffett the majority owner of a failing textile business. Wow, what a storied past Berkshire Hathaway has, and how Warren came to acquire it all. So 1965 is when he took total control. Did he continue with the mills, or were they cut at that exact moment? Buffett initially maintained Berkshire's core business of textiles, but by 1967, which was 2 years after he took over, he was expanding into the insurance industry and other investments. Berkshire first ventured into the insurance business with the purchase of the National Indemnity Company. In the late 70s, Berkshire acquired an equity stake in Geico, which stands for Government Employees Insurance Company. Right, so textiles were starting to be phased out, insurance was being phased in. When did the last mill actually close? In 1985, so 20 years after Buffett bought it, the last textile operation, Hathaway's historic core was shut down. So I guess we can call Warren a man of the cloth. That's a fascinating history into Warren Buffett's takeover of Berkshire Hathaway, but now he's got rid of all the mills. How has it performed in more up-to-date times? Here is a chart of Berkshire Hathaway versus the S&P 500 between 1990 and 2000. We see Berkshire in purple and we see the S&P 500 total return in orange. On the left, you'll notice they're pegged at exactly the same point. So that's artificial. That does mean from whatever happens on the rest of the graph is the difference in their performance. You'll notice in the middle that purple, so Berkshire Hathaway actually did outperform, but yeah, basically ended up down. 143% if you're in the S&P 500 over that decade, or 57%, that's less than half. Yeah, Warren, that was not a good decade for you. So we'll add to the cons list underperformed between 1990 and 2000. Here's a chart between 2010 and 2021, so much more up to date. And we notice they're basically neck and neck until much more recently when we see the S&P 500 has outperformed Buffett again. 443% return over that decade versus 355% if you're with Berkshire Hathaway. So we'll have to add to the cons list underperformed from 2010 to 2021, which is 11 years. That's a bit of actual performance data. I will do much more in-depth analysis coming up shortly, but Warren Buffett has said that he is now not able to perform like he used to when they were younger, when they were a partnership. Why? Well, Berkshire Hathaway has so much capital, billions upon billions of dollars. Now, small companies start and they have amazing ability to grow. They're small. They have not saturated the market yet. But if Warren comes and puts his billions in, he could end up buying the whole company many times over. And yet the growth in that, because it's relatively so small to his vast empire, even if that company that he bought up, the startup, did well, it's not going to really move the needle of the overall performance of Berkshire Hathaway very much. Now, as a small investor, if you were to do the same, you have the opportunity to buy into small companies that have great growth potential in the future. Presumably, you do not have enough money to buy out the whole company. You do not have the same problem as Warren Buffett. You probably don't have too many billions of dollars in the bank. Therefore, according to Warren himself, you, as a small investor, actually have an advantage over the gigantic Berkshire Hathaway in potential performance. So we're going to add to his cons list, large investment pools have fewer opportunities. Something else we need to consider, Warren Buffett is really old. Here is Warren Buffett in more recent times in a golf cart. Hello Warren, how did your game go? Warren, as of right now, is 92 years of age, born in 1930. How many people do you know that were born in 1930? Isn't Warren kind of like in a partnership with Charlie Munger? Well, yes he is. Here is Charlie Munger, who is 98 years of age, born in 1924, so not getting any younger. I've enjoyed watching many of the interviews with Warren Buffett. A lot of them are actually available on YouTube. I've noticed, though, in more recent years, particularly in his shareholder meetings, the annual meetings which they take for Berkshire Hathaway, he's really been struggling. So he'll get a question from the audience, and you can see the wheels are turning over, but they do take a while. And when he comes to speak, he's kind of laboured in his speaking. I'm not surprised. He's 92 years of age. He's not getting any younger. How many 92-year-olds do you know that are running a whole company? My parents are in their late 80s, so quite a bit younger still than Warren Buffett. I've watched my parents slowly decline over the years. They were probably right up until late 70s, maybe the beginning of the 80s, but in the last 7 or 8 years, there's been a definite, distinct decline. When I talked to my mother, she could understand on the surface. She seems bright, she seems to be intelligent, but you don't have to talk about anything too complicated where she very quickly tops out. She will say to me, no, that's just too complicated. I can't think that through. When you're dealing with a younger person, often you only simply need to explain it to them again and, right, I get it now. But with my mother and with my father, I've noticed they've got caps above which they will never ever go. It's sad, but that's just the reality of getting older. Warren Buffett may, at the age of 92, not be impaired at all, but seeing what my parents have gone through, seeing how different Warren Buffett is now when people ask him questions as opposed to, say, 10 years ago, then I can't say for sure that he has not, to some extent, declined. If you're enjoying this video so far, go ahead and say thanks by giving me a tip. Thanks. So, what is the future for Berkshire Hathaway? Presumably, Warren Buffett is not going to live forever. That we can say for sure. So what are his plans? Well, on the 3rd of May 2021, Warren Buffett chose Greg Abel to be his successor as CEO of Berkshire Hathaway. So if you're going to buy Berkshire Hathaway today, you're really buying into a Greg Abel company, not so much a Warren Buffett company, if your plan is to hold it over the long term. By the way, Warren has said that the company after he goes will be carrying on exactly the same tradition, the same investment style as they've been doing the entire time. But ultimately, we have to see that for ourselves. We have to see what Greg does, what his new team do, and we'll judge that for ourselves. So we'll add to the cons list. Berkshire soon not controlled by Buffett. There's some of the pros and cons. My job is to objectively assess how Berkshire Hathaway has performed relative to the S&P over the last few decades. To do that, we will compare Berkshire Hathaway Class A shares. They're the ones that have been around right from the beginning. They've never had a stock split. That's why they're worth so much money. Class B came around more recently, so we'll ignore those. Class A shares, the original Berkshire Hathaway versus the S&P 500, but the S&P 500 total return. Why total return? Because of this. Once again, the question will be asked, why doesn't Berkshire Hathaway pay dividends to its shareholders? The short answer is that the company founder is definitely not the company founder, we've established that, and CEO Warren Buffett believes that the money can be better spent in other ways. And this is true. I think once, maybe, they've paid out a dividend. Other than that, no. They retain their money to invest. So the S&P 500 companies do pay dividends. They're paltry, they're pathetic. The dividend rate that they pay out is rather small in comparison to Australia. So if they are paying out dividends then and Buffett isn't, then we really need to compare the S&P 500 total return. What is total return? Well, it's like the S&P 500 hasn't paid out the dividends. We retain them in the graph. Because the graph retains its dividends, and that becomes a fair comparison to Berkshire Hathaway. Here is the one-year graph. This snapshot was taken right today. Berkshire Hathaway Class A shares here is in blue. The S&P 500 total return, which means retaining dividends, is in red. Well, they go along quite well there, and we see all blue. Berkshire Hathaway outperforms the S&P 500, minus 0.44% versus the S&P's minus 8.65. Well done, Warren. Over the 2 years, we see, well, red is coming up in top, but then sometime in 2022, when the world went to you-know-where, we find that Buffett is actually outperforming the S&P 500, doing it well. It's had a bit of a dip there as well, but 28% return over 2 years versus 21%. So 2 years in a row, Warren has outperformed the S&P 500. Over the 5-year period, we notice that red gets ahead in time around about March of 2020, when the virus, whose name we can't speak of, actually came into effect. In red, the S&P 500 has taken off during that period. Berkshire Hathaway, well, it's grown, but nowhere near as good. Overall, the S&P 500 over 5 years returned 75%, whereas Berkshire has returned 58%. 1 and 2 years goes to Warren, 5 years, that's 10, 5 years goes to the S&P 500. Let's talk about 10. Over the 10 years, we notice they're traveling together, but red, the S&P 500 takes off and actually wins. 248% if you're in the S&P 500 or 228% if you're Warren. Now, not too bad. It's only a slight underperformance, but that matters. That's like 20%. This totally makes sense to me. Warren Buffett is a value investor. Value investors do well in turbulent times, but tend to fall behind when it comes to strong bull markets, which we've certainly had over the last 10 years. More recently, not so much. The bull market is over and Warren starts to pick up. Interesting. Over the 20-year period, we notice, well, they're somewhat similar again. Red, the S&P 500 is out in lead, and it does win. 539% rather than Warren's 473%. So S&P 500 wins again. Warren, you're not looking so good. Okay, let's go back to 30 years. Can Warren actually reclaim his throne? We see, blue has jumped out in front very early on, and that's it. Well, they add up, don't they? 4,000% over 30-year period versus the 1,600 for the S&P 500. This is fascinating. The last 20 years, the S&P 500 has won. Over the last 30 years, Warren has well and truly trounced the S&P 500. Over 40 years, Warren Buffett, well, it's beaten the market. Look at that. 88,000%, I kid you not, versus the 21,000 of the S&P 500. Wow and double wow. We can see why Warren Buffett has been so revered for his amazing performance. Keep in mind that this performance does include the more recent years, but it does appear that most of the performance was done in the early years and not in the last few decades. Over the 50 years, which is the last one we're going to look at, blue outperforms red really so much. 154,000 versus 37,000. Yeah, wow. So the winner over the 1 year is Berkshire. Over the 2 years is Berkshire. Over the 5, S&P 500. Over the 10, S&P 500 20. And then 30 plus, we have Berkshire Hathaway. Overall, Warren has won, which is pretty amazing. But over the last 20 years, no, he definitely hasn't won. Let's draw some conclusions based on that. Warren's last 20 years of bad luck could be explained away that a massive bull market has taken place, which is not good for value investors. I mean, that's one option. Option number 2 is that Berkshire Hathaway is having too much money, therefore fewer investment opportunities. We know that for a fact. That part's true. Option number 3 is Warren's getting older. We know that is true. My conclusions are, over the long term, Buffett has outperformed the market significantly. If Buffett were to live forever and stay 50 years old, Berkshire would be very compelling. Wouldn't that be great? The Warren of yesteryear actually living on forever, and you can just say, oh, just bank on Warren because what he's done in the past, we'll know he'll do it again. Unfortunately, he's not getting any younger. If Berkshire Hathaway was an index fund with a passively determined system, it would be very compelling. In reality, it's an actively managed fund. That would be amazing if Warren, instead of actually investing in companies through his own research, which is exactly what he's done, that's part of his success, but instead implemented a system, a mechanical process which other people could follow. So it becomes no longer actively managed, but it's a type of index. Then you could take the past performance and replicate that onwards because it's a mechanical system and say, based on the probability, what's happened in the past will happen again, but that's not the case. It's up to active managed decisions, and therefore, once Warren's gone, can we really say that the system in place is amazing? Well, no, we can't really. Buying Berkshire today for the long term is buying a Greg Abel company, not a Warren Buffett company, because presumably he's not going to live forever. So, if you were to invest today, would you invest in the S&P 500 or in Berkshire? That's entirely up to you. I've given you the raw data, lots of it. You have everything right there in front of you. How you choose to take that and make use of it is entirely up to you. And should I be investing in the S&P 500 anyway? What about, say, the NASDAQ? Is that a better option? Well, I'd have to look at some data on that. Fortunately, I've done a video. Go ahead and watch it here, and we'll answer the question for you.